Hello friends, welcome to the August edition of Monthly Viewpoints. After the election results, Indian equity markets had touched all-time highs at the beginning of June. However, after the announcement of the Union Budget in July, the large cap Nifty index has declined almost 8 to 10%, while the mid cap and small cap indices have declined almost 10 to 12%. This indicates heightened pessimism in the market. Now, while the market sentiment can swing from extreme optimism to pessimism very quickly, it is crucial for us as investors to follow our asset allocation strategy diligently based on an understanding of the risk reward in the market. So let's start with the growth outlook. Now, there has been a concern in the market on account of three main factors. One is that we have been seeing a continuous slowdown in consumption over the past 6 to 8 months, and we have not seen any direct measures from the government so far to address this slowdown. Secondly, while there is enough liquidity available in the system, the NBFCs are not able to access funding due to high risk aversion. Real estate developers are also undergoing some pain due to the NBFC funding issues. Overall, the lack of money flow in the system is constraining growth. Lastly, there was a measure in the budget to increase the tax surcharge on foreign portfolio investors. This has negatively impacted their sentiment, leading to a large outflow of more than $2 billion in the month of July. In addition, globally, there is some element of caution as the trade discussions between the US and China have not gone as smoothly as expected. However, there are some positive points also for us to note. Firstly, the RBI has cut its monetary policy rate by 35 basis points at its latest meeting, and in total, they have cut rates by 110 basis points so far this year. We expect further rate cuts in the next few months. Secondly, the strong monsoons will aid rural consumption and improve rural sentiment. This can help to increase consumption in the next few months. The government also seems to have realized the gravity of the situation. They have started meeting representatives from various sectors and are considering measures to address the concerns of the sectors as well as the foreign portfolio investors and the capital markets. Lastly, globally, we are in an environment of easy monetary policy. The US Fed also recently cut its policy rate, and the commentary from the rest of the central banks like the ECB, the Bank of Japan and the Bank of China has also been dovish. So overall, we can say that the GDP growth may be muted for the next few months, but we should expect to see some green shoots of recovery in the latter half of the fiscal year. As the government measures start having an impact, we expect that both consumption and investment should start picking up. Now, in the first term, the government had implemented certain reforms like IBC, GST, and the PSU bank recap. Their priority now is to streamline those reforms and continue on the reform path with measures such as labor regulations, land acquisition, and legal reforms. We believe that this will help to take India back on the 7.5 to 8% GDP growth trajectory in the medium to long term. Now, coming to valuations, if we look at the yield gap ratio for the BSE 100 based on the forward earnings multiple, it is now close to 0.9 times as compared to the long-term average of 0.8. This indicates that equities are in a relatively attractive zone. The 1-year forward P multiple is about 18 times, and the 1-year forward price to book multiple is about 2.5 times for the BSE 100, again indicating that equities are reasonably priced. Lastly, in terms of mid caps and small caps, they are priced attractively as the forward PE multiples are lower than the long-term average. So coming to the overall risk-reward analysis and our view on the markets, we think that the earnings growth may be subdued in the first and second quarters of fiscal year 20. However, as we see some green shoots in recovery in Q3 and Q4, the earnings growth should also come back. And in the medium to long term, we expect long-term sustainable growth to be driven by the economic recovery and the reforms being implemented by the government. We remain constructive on India's overall economic growth in the medium to long term and suggest that investors continue to increase their exposure to equities, especially through SIPs. The risk reward for equities seems balanced at this point. However, from a long-term perspective, it is attractive. Select themes we are participating in include consumption, which covers the consumer staples, low-ticket consumer discretionary, and the retail sectors, financials, which includes private banks, corporate banks, and select NBFCs and insurance, pharma and healthcare, and export-oriented sectors like IT. We offer a basket of suitable funds for investors to choose from. Thank you and happy investing.